We all know that interest rates are something important. Central banks control them, and lowering them can boost the economy. And the biggest action central banks can take is to adjust interest rates. But have you ever thought about why they're so important? Who decides them, the central banks or the market? Why does lowering them stimulate the economy? Why are they raised during inflation? What is the relationship between interest rates and the stock market? How do they affect exchange rates? I think it is one of the most important concepts in an economy. So what exactly are they all about? It's certainly a broad topic. So today I want to focus on a few main points and clarify the underlying logic and some concepts that people often get confused about. Interest rates, also known as interest, are something most people have heard of. For example, if the interest rate is 2% and you save $100 in the bank this year, you'll get $102 next year. And if you borrow $100 from a bank this year, you'll have to pay back $102 next year. You can think of interest rates as the time cost of money. Today's $100 is equivalent to next year's $102. Now, why are interest rates so important? Let's simplify this question. Imagine an economy where all interest rates are the same, whether for deposits or loans, and regardless of whether you're saving for 1 year or 10 years. So what happens if we reduce the interest rate from 2% to 0%, assuming all other conditions remain the same? Well, everyone holding money will think, there's no interest in saving it in the bank. Might as well spend it on buying a house, a car, a handbag, or invest it in starting an online business or a restaurant. In short, people will save less and increase their consumption and investment. At the same time, everyone will see that borrowing money costs nothing and will be more inclined to take out loans. Companies will borrow to expand production, hire people, promote sales, invest, and so on. When the interest rate is 0, people will borrow more, invest more, consume more, compared to when the rate was 2%. Many will take out loans to buy houses. Those who sell houses will have more money and might buy cars. Car sellers will get richer and may buy handbags. Handbag sellers get more money and invest in houses. This cycle makes the entire economy more active. So you see, just by reducing the interest rate from 2 to 0%, everyone starts making more money, working harder, and the lives of all people improve. And central banks across the globe are well aware of this. Whenever there's a problem in the economy, they quickly lower interest rates to stimulate it. For example, in 2020, the Federal Reserve in the US was ready to raise interest rates, but when the pandemic hit, they immediately cut rates to boost the economy. Europe and Japan had already lowered rates earlier to stimulate their economies, and they had been laying low at nearly 0% for over a decade. So it seems like a central bank's job is easy. Simply cut interest rates and the economy will spring to life, right? But no, that's not too reasonable. Let's return to the example we discussed earlier because I only told half of the story. We said that when interest rates drop from 2% to 0%, the overall economy becomes more active. Unemployment rates drop and everyone will have more money. But what happens next? Businesses will notice that people have more money and demand is higher. So, the prices of handbags will go up. But not just consumer products, the prices of raw materials like leather and machinery also rise. Eventually, everyone's wages go up too, and this will cause inflation. But when you increase interest rates, it's a different story. In the short term, it slows down the economy a bit, and in the long term, it helps to keep inflation under control. It's like using a speed limiter to make sure things don't get too heated up. That's exactly what countries around the world have been doing recently with their rapid inflation. They're raising interest rates. So from our analysis, we can draw a basic yet crucial conclusion. Lowering interest rates speeds up the economy temporarily, but do it too much, and you risk overheating with inflation. Rising interest rates, however, slows things down and keeps inflation in check, like using the brakes to make sure you don't go too fast. Now let's look at some recent news. The Federal Reserve raised interest rates to 5.5% in July. The European Central Bank increased the rate to 4.5% in September. The Royal Bank of Australia raised interest rates by 25 basis points to 4.35% in November. So now let's suppose you go to a bank to take out a loan to purchase a property on a 10-year loan, and the bank charges you an interest rate of 5%. But what makes the bank set it to 5%? Let's break down how the bank thinks. There are mainly three parts. The first part is the risk-free rate, say 3%. The second part is the risk premium, say 1.8%. The third part is the bank's profit, or the money they want to earn, say 0.2%. Adding these up gives the 5% rate you see. Profit margin depends on market competition and the bank's situation. The risk premium is based on the borrower's financial situation, income, collateral, etc. Through a series of complex financial models, the bank determines the likelihood of the borrower's inability to repay the loan. The greater the risk, the higher the premium. The remaining component is the risk-free interest rate, which is really important for understanding how interest rates work in the economy. There are various interest rates in the market: deposit rates, credit card rates, mortgage rates, rates for bonds issued by companies. All these are based on the risk-free rate. And this is the rate that we usually talk about. So what is a risk-free rate? Imagine someone who is 100% sure to pay back a loan. The interest rate given to such a super reliable borrower is what's called the risk-free rate. In the real world, the closest thing to this super reliable borrower is usually the government of a big economy. The bonds they issue, like those from China, the US, Japan, or Germany, have interest rates that are considered almost risk-free for their currencies. The prices of these government bonds help us to figure out their interest rates. For example, if a 10-year bond from the US government has a certain price, we can use that price to work out an interest rate. At the time of writing this, the rate is 4.252% for a 10-year US bond. You don't need to know how this calculation is done, but this 4.252% is the interest rate for a 10-year US Treasury bond, which is the 10-year risk-free rate for the US dollar. Each currency has its own set of these rates for different time periods, like 30 years, 10 years, 5 years, and so on. If we plot these rates on a graph over time, we get a line called the yield curve. The core interest rate in an economy is not a single number, but this curve. And this curve is the benchmark, the foundation of the economy. Usually this line goes up, which means the longer you lend your money, the more interest you expect. But sometimes you'll see in an economy that the medium to long-term rates are lower than the short-term rates, like a 10-year rate being lower than a 2-year rate. This situation is called an inverted yield curve, or yield curve inverted. But that's a topic for another day. So, isn't it a bit contradictory that the yield curve is derived from the price of the bond, and the price of the bond is set by the market? Didn't we just say that central banks control interest rates? So what specific rates do they control? It varies among central banks, but it's usually the shorter-term interest rates that are controlled. For example, the Federal Reserve in the US, the Bank of England, and the European Central Bank control the overnight lending rates, which are the rates for one-day loans. This overnight rate is crucial for banks, and this is what central banks manipulate. For instance, after the 2008 financial crisis, the Federal Reserve kept the overnight lending rate, or the Fed funds rate, between 0 and 0.25%. The recent interest rate hikes we hear about across the world are also for this one-day rate. All other interest rates are influenced through the government bond market or the mortgage-backed securities market, MBS, so they aren't directly controlled by central banks. Now, although they can't control these directly, after 2008, central banks realized that just controlling the overnight lending rate wasn't enough. In desperate situations, central banks would print money and participate in the market. For example, if they find the 10-year government bond rate too high, they buy 10-year bonds. If the 30-year rate is too high, they buy 30-year bonds. If the mortgage rates are high, they buy MBS. And what's the goal? To keep long-term interest rates down. This is what we often hear as quantitative easing, QE. So when we look at loans, we usually consider long-term rates like 10-year, 20-year, or 30-year. In other words, whether central banks raise or lower interest rates doesn't have a significant impact on long-term rates. What really affects them is whether there is quantitative easing, tapering, or tightening. Before we move on, let's do a quick recap. The key to economic activity is the circulation of money, and at the heart of money circulation is the interest rate. The foundation of interest rates is a risk-free rate curve. Central banks typically control short-term rates or overnight lending rates, while long-term rates are determined by market supply and demand. Central banks can try to influence them but cannot absolutely control them. So the question arises, how do interest rates specifically impact our lives and the economy? If you understand all the theory I just explained, you might be able to deduce it yourself. First, let's look at the relationship between interest rates and inflation. We said earlier that prolonged low interest rates lead to inflation. So this is why when the US sees high inflation, the market immediately expects the Federal Reserve to raise interest rates. And it's usually a more significant jump, like 0.5%, to quickly suppress inflation. In June 2022, the inflation in the US was over 9%. Back then, it was predicted that in the next 5 years, inflation will average around 3%. By October 2023, inflation had indeed been reduced to 3.22%. This shows that people are not too worried. They believe the Federal Reserve is able to control inflation by raising rates. Now look at Turkey. Recently, their inflation shot up to 62% again. There are many reasons for this, like politics and sanctions from the US. But a big reason is that Turkey's president is very unusual. He believes that interest rates are the source of all evil and don't help fight inflation. So instead of raising rates, he wants to lower them. We've talked about their crazy economy in another video. So you see how interest rates and inflation are closely connected. But what else is closely linked to interest rates? We also said earlier that the long-term interest rate is derived from bond prices. It's a simple rule in finance. If interest rates go down, bond prices go up. If interest rates go up, bond prices go down. Imagine the government must issue new bonds with higher interest because the rates went up. Suddenly, the old bonds with lower interest don't look so good anymore. This reduces demand and therefore price of the bonds. So this means that bond prices and interest rates usually move in opposite directions when they have the same term. However, the relationship isn't so straightforward for bonds of different terms. Remember, we said that interest rates make a curve and central banks control these short-term rates. But what's actually relevant to our lives are the medium to long-term interest rates. They range from about 2 to 3 years up to 20 to 30 years. We can think of these long-term rates as a combination of several expected future short-term rates. Have a look at the 5-year government bond yield in the US. It is increasing. This is partly because the Federal Reserve increased the overnight lending rate, or Fed funds rate. On the other hand, it is also due to the Federal Reserve chairman. Everyone expects him to persistently increase interest rates to curb inflation. Therefore, midterm rates are also increasing. Alright, now let's move on to the relationship between interest rates and stocks. How exactly does raising interest rates affect stocks? Well, it's not as clear as with inflation and bonds. And just a heads up, I'm not giving financial advice here. Let's start some theory. For example, let's say interest rates have risen both short-term and long-term. So what happens then? Companies have to pay more when they borrow money from banks or issue bonds. This means it's more expensive for them to get money, which can slow down their growth. This is generally not good news for the stock market. So, higher interest rates can be tough for business that rely a lot on borrowing money, especially if a large part of a company's balance sheet is made up of short-term debt. For consumers, the story is similar. As we discussed, the cost for companies to borrow money goes up. The same happens for consumers. Our costs for mortgages, car loans, and credit card loans all increase. This makes borrowing more difficult and expensive. People will certainly reduce their consumption, which leads to a decrease in overall demand, which then makes it harder for the companies to make money. So broadly speaking, higher interest rates are bad news for publicly traded companies. Industries that depend heavily on loans, like housing and cars, are more affected. When loans for homes and cars become more expensive, people cut back on these big purchases, which affects these sectors significantly. You've never heard of anyone taking out a loan to buy toilet paper, right? Then you can also think about it from a valuation perspective. Consider a company's theoretical stock price, which should represent all its future cash flows discounted to their present value. This discount rate is essentially the interest rate. So if the interest rates go up, the discount rate also increases. This means that when you discount future money to its present value, it becomes less valuable. Therefore, from a valuation perspective, rising interest rates negatively affect stock prices. And this has an even bigger impact on young, developing companies. Their profits are expected much further in the future. So when you discount those future profits back to their present value, they become much smaller. However, the actual impact in real life is still quite minimal. Another aspect to consider is liquidity. Just as you can easily use money in your wallet to buy things quickly, if something is liquid, It means you can quickly turn it into cash and use it whenever you need it. So now think about it. When interest rates go up, the overall market liquidity tightens. In the short term, this is definitely bad for the stock market. And this is actually the most significant and direct impact that interest rates have on the stock market. So, what we've just explained from different perspectives is how raising interest rates can lead to a fall in stock prices. But this is just the first layer of the impact. Economics is intriguing because it's multidimensional and complex, with many intertwined factors. Let's take real estate as an example. Higher interest rates generally don't favor the real estate market, but during times of inflation, it is necessary to fight it. But what then often happens is that many people choose to buy property during inflation as a way to counteract it. So from this perspective, higher interest rates can actually be good for the housing market. This creates a contradiction. It's not always clear-cut. For example, over the past 30 years in the US and Europe, the real estate market has often performed relatively well during periods of high interest rates. The cause and effect in economics might not be too hard to understand, but the challenge lies in its complexity and the interconnectedness of various elements. Interest rates are a significant tool for macroeconomic control and affect the entire economy. However, when you look at each individual company, each stock, you'll see that there are a lot more factors that can affect it than just interest rate. The impact of interest rates on the economy is like the moon's impact on the Earth. Think about it. The moon affects the Earth's tides and its rotation. That's a significant impact, right? But as an individual, you don't jump higher at night just because there is a moon in the sky. For you personally, there are many other factors that determine how high you can jump, and the moon's gravity probably doesn't even make it into the top 10. Not sure if this makes sense, but I hope you can appreciate this analogy. Anyway, back to the topic. So when the central bank announces an interest rate hike, it's usually seen as bad news for the stock market. And while the immediate reaction to a rate hike might be negative, the stock market's behavior over the following months or maybe even days is unpredictable. This is because the stock market doesn't just react to interest rates alone. It's influenced by a multitude of factors, including economic conditions, company earnings, global events, investor sentiment, and more. So you shouldn't rush into the stock market just because you hear about a rate cut. It's not a wise move. Of course, rate hikes can be good for some industries, like those in the business of interest rates, such as banks and insurance companies. For banks, which earn money from the difference in lending and borrowing rates, very low interest rates are not profitable. If you look at the history of US banks, you'll see some correlation between bank stocks and the yields on 10-year government bonds. Then there's the topic of quantitative easing, QE, which has a more direct and immediate impact on the stock market compared to interest rates. If you look at the past decade in Europe, the US and Japan, where QE has been implemented, you can easily see its effect on the stock markets. But we'll dig deeper into QE another time. Alright, let's talk about how interest rates affect housing prices. It's quite similar to their impact on real estate in general. When interest rates rise, the cost of borrowing increases, which is usually bad for the housing market. However, as we mentioned before, high interest rates often occur during periods of inflation. And if inflation persists and the stock market continues to fall, many people shift their investments to real estate. This in turn can actually be good for the real estate market. But in fact, it's all very uncertain. The same theory applies to gold as well. High interest rates increase the yield on bonds, which leads to money moving from gold to bonds. So theoretically, when interest rates rise, precious metals like gold should fall in value. And if you look at the past few decades, the relationship between gold and government bonds is quite apparent. There's a noticeable negative correlation. Therefore, raising interest rates tends to be bad for gold. But in an inflationary environment, especially one with dollar inflation, people tend to buy gold to hedge against inflation. This then becomes a positive factor for gold. So again, it's all very uncertain. And lastly, what about the impact of interest rates on exchange rates? You can think of interest rates as the return on investing in a country's currency. For example, if the US Federal Reserve decides to increase their interest rates, then saving money in US dollars becomes more profitable. Because of this, more people want US dollars, so its value goes up compared to other currencies. However, exchange rates aren't just about one country, they involve relationships between countries. So, we need to look at relative interest rates. or how much interest each country is giving for their money. For example, if the US increases its interest rate and Europe increases theirs even more, the euro will be worth more compared to the US dollar. This is the interest rate differential. When one country's currency becomes more attractive to save and invest in because of higher interest rates, it can get stronger compared to others. Right now, for example, the US is raising its interest rates, which makes the dollar stronger. At the same time, China is lowering its interest rates, which makes the yuan weaker. This difference makes the dollar even stronger compared to the yuan. But remember, lots of things can change how a country's money is worth. For example, high inflation rates can put downward pressure on a currency. If a country exports a lot, its money can become worth more. The same happens if people have a lot of confidence in the market. And sometimes, governments and banks step in to change things too. So there you have it. All you need to know about interest rates. Hopefully it's easy to understand. It took a while to put together. If you liked it, please give a thumbs up and subscribe. See you in the next one.